welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The universe gives signs. I just wish mine weren't always low battery and storage full. I asked life for clarity. It sent me 3 contradictory notifications and a software update. Every meeting has one person whose role is unclear. If you can't spot them, it's you. The data is mixed. Translation: I have no idea what's happening, but I'm willing to sound confident about it. Buy the dip is great advice, unless the dip has decided to become a lifestyle.
The 2025 US stock rally has a clear most valuable person, and it's Alphabet. The S&P 500 added $6.6 trillion in value this year, and Google's parent alone delivered 19.4% of that. That's $1.28 trillion, basically one giant company doing the heavy lifting for an entire index. Nvidia wasn't too far behind at 16%, Broadcom chipped in with 7.8%, and Microsoft added 5.7%. The rest of the top 10 together contributed less than what Alphabet did on its own. So this rally isn't broad. It's turbocharged by a handful of giants, and with Alphabet in the driver's seat. Everyone else is just drifting behind. Central banks around the world have been easing quite a bit. Over 80% of the world's major banks have cut rates this year. Inflation has cooled almost everywhere, pushing real interest rates into mildly positive territory for most developed markets and sharply positive across emerging markets. The big movers: New Zealand, Canada, Europe, UK, Australia, and India. Japan and Taiwan were the rare hikers, fighting stickier inflation. Turkey and Argentina still live on another planet with eye-watering rates of 39.5% and 29%. Real rates tell the real story. The US, Europe, and most of Asia now run near zero real rates. Emerging markets like Brazil, Mexico, Indonesia, and the Philippines sit on healthy positive real yields. Q2 earnings delivered a solid bounce, but the market's enthusiasm not so bouncy. Oil and gas posted a 41% PAT surge with a modest 11x price to earnings. Metals grew 24% with an 18x PE, and the Nifty 50 still trades at 22.5 PE, much below its 5-year average of 24. Across sectors, valuations remain under long-term bands despite profit growth. Rare earnings price disconnect. Realty and capital markets saw deep PAT drops, but most other sectors are quietly improving beneath the surface. So is this the setup for a classic mean reversion rally? Possibly. If earnings hold and liquidity stays supportive, multiples could migrate back towards their historical lanes. Gold demand hit 1,313 tons in Q3, up 3% YOY, and the strength is broad-based. Here's a sharper, crisper breakdown. Jewelry demand stays the largest and most stable chunk. Households are still buying consistently. Bars and coins, in blue, rise steadily through 2025 as falling global rates revive investment sentiment. ETFs in red have stopped bleeding and show small inflows, a sign that institutions are quietly returning. Central banks in purple remain the biggest structural buyers, driven by de-dollarization and geopolitical hedging. OTC flows in yellow jump in Q2, Q3 2025, signaling large strategic or sovereign purchases. So the bottom line: every major segment is supporting gold, retail, investors, and central banks. Demand isn't cyclical anymore, it's quite coordinated. UBS just turbocharged its copper outlook, now calling for $13,000 per ton by December 2026, with sharp upgrades across every quarter of the year. What's driving this? Demand boom, AI data centers, EVs, renewables, all copper-hungry sectors exploding at once, and a supply squeeze. Persistent mine disruptions mean fresh supply isn't keeping up. The deficit widens just as green energy demand spikes. In short, surging demand plus stubborn supply issues is equal to the perfect copper storm. China has gone from just 2% EV sales to nearly 50% in just 7 years. That is as a percentage of total cars sold, a pace that no country has even come close to. The chart says it all. All combustion car sales peaked in 2017 and have been sliding ever since, while electric vehicle sales keep rising and now account for 48% of all new cars sold. Two big forces power the shift: policy muscle, subsidies, charging networks, and aggressive local manufacturing, and consumer adoption. EVs are now cheaper, better, and everywhere, from premium sedans to tiny city cars. India is now the third largest quick commerce market, overtaking Japan, Korea, and even the EU. But here's the scale check. China is at $92 billion, the US at $63 billion, and India only at $5.4 billion. The real story is growth. India is projected to be the fastest growing market amongst the top three through 2030, with 15% plus annual expansion. And with Blinkit, Zepto, Instamart, and BigBasket racing into 70 to 100 cities, quick commerce is moving from metros to mainstream. With 20 million active QCom shoppers and over 4,600 dark stores already operating, the runway is quite long. India's demographic engine is unmatched. By 2025, the world will have 5.3 billion working age people, and India alone will contribute over 1 billion of them, more than any other country, even China. Across every key age band, 18 to 23, 25 to 49, and 15 to 64, India holds the largest global share. And this advantage doesn't fade soon. By 2040, India is projected to command 19% of the world's workforce. While the West ages and China's working population shrinks, India's young workforce becomes its defining competitive edge. No other nation can match the sheer scale of employable youth. Now to the reality. India may have the world's largest upcoming workforce, but here's the catch. 65% of people aged 15 to 59 have no vocational training, and only 73% have secondary school education or less. That's a massive skill gap sitting right under a massive demographic advantage. Only 4% have received formal technical or vocational training. Most rely on hereditary skills, on-the-job learning, or self-learning, not enough for a modern competitive economy. The opportunity, of course, enormous. EdTechs, corporates, MSMEs, and institutions have a once-in-a-generation chance to skill up millions from AI basics to healthcare, customer service, logistics, and entrepreneurship.